Hello, everybody, and welcome to the Investing with IBD podcast. It's Justin Nielsen, your host, and joining me, as he does every week, is Arusha Pires, portfolio manager over at O'Neill Global Advisors. How are you doing this week, Arusha?
I'm doing well, Justin. It's always great to be here.
Yep, and I'm looking forward to a Pac-12 tournament here for basketball. I went to a few UCLA basketball games. USC didn't do too bad, so we'll see how this
Hanging in there.
plays out. Yeah, hanging in there. But let's get to our really, really special guest, and this is someone returning to the show, Bill Studebaker. He's the president and CIO and managing partner of ROBO Global. Now, what ROBO Global does is they've got a lot of sticks in the fire here in terms of robotics, automation, AI. And we thought it would be a great idea since AI is on a lot of people's minds with all of this chat stuff coming out to have Bill talk a little bit about that. So, welcome back to the show, Bill.
Good afternoon. Thanks for having me. Look forward to our conversation.
Okay, so we're going to start off with a little bit of where the market is, and we're going to get Bill's kind of insights into the idea behind staying the course and with the recession talk and everything like that, almost a panic for some people. What can kind of get us out of this to a degree, and with productivity? And then he'll give some broad themes of what he's seeing in the robotics, automation, and artificial intelligence area. So let's go ahead and get a start with the Nasdaq Composite. Maybe the growth was so strong in the Nasdaq for January, February. We've seen a little bit of a pullback here, and a lot of this is being kind of, I guess, driven by some uncertainty with the Fed. Testimony from Jerome Powell yesterday and today in front of Congress to say, hey, look, we might have to raise interest rates a little bit more. We had a JOLTS report today. We've got, jobs data, CPI, Fed meetings, all of those things acting as headwinds as people are starting to try and figure out exactly how high interest rates will have to go to calm inflation down. So, Bill, what's your take on where we're kind of at after such a devastating 2022 for a lot of people? A nice rebound so far. Where do you think we're at right now?
Well, listen, I think it's hard to have a crystal ball, but here's my attempt. I think that navigating an environment where good news turns into bad news and
Yeah.
soft landings become, kind of no landings. It feels like we're taking a test we haven't really studied for, and this is, kind of exhausting for investors and any participants, in the market. And I think even the teachers, right, the Federal Reserve doesn't even seem to have, the answers. And
Hmm.
I think the important thing here is that if you just look at the numbers and the data, you look at the PMI indices, globally, they point to a simple fact, which is that the global economy remains far more resilient than most people expected. And I think that just as investors got comfortable with the idea, this might not be a good time to be bearish, or it was a good time to be bearish. All last year, and then continue it going into this year. The U.S. market started its slide into kind of the view or the hope or the anticipation of a soft landing, and then we've had a rather sustained rally in the markets, and that's as a result really that of digesting a fair number of earnings beats, along with some arguably some encouraging macro data. So it's been welcomed, if not, somewhat bewildering news for many people after the heels of a very disappointing 2022. But as I see it, I actually like the fact that we're getting some dispersion in returns. I know that everyone loved that when the green light was on, particularly kind of in 2019 and 2020, and everything was up. If it was
Right.
a green day, everything was up, and if it's a red day, everything was down, and it was up similar, amounts, and down similar amounts. But it's different. I mean, I can talk about what we're seeing, which is our Robo index, which captures the ecosystem of robotics and automation, is up 15% year to date. The ticker is Robo, ROBO. Our AI index that sort of invests across the value chain of robotics and AI is up 19%. And our healthcare innovation index is up about 2%. So kind of similar, believe it or not, to most healthcare indices that are down anywhere between 5%, up 5%. But if you look at the dispersion of the markets, you've got the S&P, up 4, you've got the Dow down maybe 1 or 2, the S&P up, 10%, global diversified, like Act's up 5%, Europe's up kind of in the mid-teens, Nikkei's up somewhere around 9%. So, there you have it. I think it's good that now, guess what? We're back to a stock pickers market.
Hmm. Yeah. And given that growth got hit so hard in 2022, a lot of times people say, "Oh, the harder they fall, the more they bounce back up." Are you kind of expecting, that for some of the, again, because a lot of what you're invested in is very very growthy? Is that kind of the expectation that maybe 2023 or beyond kind of holds a little bit better of a bounce?
Yeah, I think so. I think as we came into 2023, as I sort of written in our previous market commentaries, that I thought that the risk reward is becoming heavily skewed in our favor. I mean, last year, most of our indices were off somewhere around 40% in that zip
Hmm.
code. So actually far worse than the global indices. Yet there was a de minimis change in earnings expectations. So what happened was just really a 40% revaluation of the multiple. And
Hmm.
so we're looking into this year, all our indices I think are going to fare very well because historically they've grown significantly more than that of the market, and I think that's going to be the continued narrative going forward. That I think the S&P is expected to grow top line somewhere in the 4 to 5% range, and our Robo Index, as an example, is expected to grow somewhere in the 8 to 9% range top line. So again, sort of twice the level of the market. And I think this sort of bizarre economy, you have to wonder if the sort of airplane metaphor is somewhat misguided. I mean, maybe Captain Powell isn't actually flying a plane, or rather a new sort of ship that just stays in the air for longer and flying us into quote unquote uncharted territory. And if we're not on the brink of a global recession, which certainly in my opinion doesn't seem to be the case, I think it's time to lose the metaphor and focus on the fundamentals of the facts. And for one, I think that investors need to have the right landing gear, which is robotics, automation, AI. I mean, these are the technologies that every economy, every geography, every company is having to employ. So I think that we are in very early days of penetration. In a baseball metaphor, we're not in the first inning of the baseball game here. The players are in the locker room putting their clothes on.
Wow, wow.
Yeah.
Now, Bill, with the markets correcting so much last year, and then this year, the markets are hanging in there, and potentially a big opportunity. Was there any change in the strategy for Robo Global, or it's you're taking a much longer view on all of these exciting kind of growth areas?
No, I mean we had some tweaking around the edges, but really nothing fundamentally changed. What we're trying to do, Rusha, is capture the companies that have the highest revenue exposure, to these themes. I mean,
Mm.
having revenue period. Okay, that's roughly 50% of sort of our fundamental factor attribution that goes into it. The other 50% is looking for companies that are market leaders, that have strong market leadership, that have technology leadership. And we also spent a lot of time looking at how and where they're investing, because that's an important component to understand, how they're using these technologies to enable their business, but importantly, how their mix is going to change as a result, of having a bigger emphasis on these areas that I think are pretty ripe for innovation and ripe for growth. And so that's kind of how we've focused, and we've not changed that one bit.
Hmm. So one of the things that seems to be a big theme right now is, and the macroeconomic side is the labor market. All eyes are on the labor market, how tight it is. Um, what does robotics and automation and their effect on the labor market do to that equation? What are your thoughts on that?
I get that question a lot, and I
I would
think
imagine,
it's
and I know you
always
have an answer.
yeah. I think it's always sort of assumed that automation is to displace workers, and although it does sound pretty scary about what AI could do from a science fiction standpoint and robotics too, I mean, really, what we've been doing very easily is automating dull, dangerous, and dirty jobs. And those areas continue to be ripe for innovation. But what we're really doing is that we're adding automation more collaborative with humans, and I think that's the biggest thing that most people misrepresent. The companies and the countries that have the highest penetration rates in automation have the lowest unemployment rates. And if you looked at Amazon, I don't have all the numbers off the top of my head, but effectively over the last 7 or 8 years, they've gone from having in the ballpark of maybe 35 or 40,000 robots to adding somewhere of a couple 100,000. And during that period of time, their employment base has grown basically commensurate to their robotic growth. And what happens, with this is that you really have better productivity, which means lower costs, which means greater economic output and demand. And so we have 11 million unfilled jobs in the United States. So if robots are stealing our jobs, as I like to joke about, they're doing a really bad job of it.
Right. Yeah, very good point. And let's kind of get into a little bit more of what you were referring to as the dispersion, and how that was a good thing. Could you explain that a little bit more? Because I want to make sure that our listeners can kind of understand what you mean there.
Yeah, well, I guess when the economy was going down, the correlation to most all asset classes was 1 to 1. So meaning that
Right.
if Amazon was down 1%, then so was Fanuc, and so was Medtronic, and so was J&J. And there really wasn't any separation in risk assets, and
Mhm.
so everyone was basically selling out of fear. They sold what they could or what they had to because they wanted to get really low at the ground as the market was going down.
And let's
And
not forget bonds weren't really the safe haven, either.
right, I mean, last year was the worst year for bonds in
Mhm,
over 50 years. So
mhm.
true, there was really virtually no asset classes that were unscathed. And so as we've entered this year again with a 40% correction of the multiple coming into this year, gave investors, sort of a asymmetric risk reward to begin to review their portfolio and reassess, where they wanted to be. I think investors got very lazy and how they're investing and what they were investing in, and robotics and AI has always been a little bit of a tricky one for people because disruptive innovation is difficult to price and to value
Right.
and understand. And I think that you also have the issue that they don't necessarily follow traditional GICS classification, meaning that there's no sort of subsector where you put in, whether it's say the biotechnology, there isn't a subsector for AI. I mean, it's a part of computing or other. Then you have robotics. I mean, there really isn't a segment for that either. So it doesn't necessarily, tick traditional, financial analyst metric boxes, um, and that's made it a little bit challenging for people to think about how to allocate. But these are names that they need to take a look at, and I think over time, that is going to change. And
Mhm.
for us, as an example, our flagship fund, Robo, less than 2% of the names are in the S&P.
Hmm.
So investors don't own these names. There's
Mhm.
roughly around a 6% crossover with the Nasdaq.
Mhm.
So generally speaking, these are names that are not investor portfolios, which I think is obviously remains a great thing and an opportunity.
Mhm.
So in the end, with a lot more dispersion, it's going to really add to those who are better at stock picking, right? Who are able to find the alpha in the market.
Yeah, I think so. And investing is not an easy game.
Right. Right.
Which is why over longer periods of time, it's very difficult to see those individuals that outperform the market. And
Mhm.
but everyone wants to identify something new and shiny, and
Yes. Yep.
this is new and shiny, but this is not a niche. I mean, the first iPhone came out, what, 12, 13 years ago, and the first iPhone that came out was a niche. So was the first, Tesla that came out in 2013.
Right. Mhm.
And 2, 3 years ago, people were sort of poo-pooing the idea that Elon Musk might get to 500 million units, or I'm sorry, 500,000 units ever.
Right.
Well,
Hmm.
now he's talking about getting to 20 million units.
Hmm.
Uh, and, this is what we're seeing in the market, with a lot of these technologies where the rates of innovation, the S curve happens so quickly and so much faster than investors can price into. I mean, Chat GBT got to 100 million users inside of 2 months. I mean, that's the quickest
Absurd.
launch of any
Right.
technology
It's
ever.
Yeah.
unbelievable.
I
Yeah.
think
Yeah.
the previous quickest launch was TikTok that got the 2 million. It took a whopping 9 months.
Uh-huh.
Wow.
So
Wow.
this is kind of what's going on.
Yeah, and we'll get into a lot more of that with ChatGPT and AI and what that means in our next segment. So stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. And welcome back to the Investing with IBD podcast. It's Justin Nielsen, your host, and joining me as he does every week is Arusha Pires, O'Neill Global Advisors Portfolio Manager. And our special guest this week, returning to the show, is Bill Studebaker. He's from ROBO Global. He's the president and CIO, managing partner over there. So, Bill, we've got kind of a lot to discuss in terms of this whole idea of the recession fears, and you kind of mentioned this before about how the landing, soft landing, hard landing, no landing, um, the idea behind the landing gear being what's most important. And to you, is that landing gear really productivity? And is that something we get from robotics, of course?
Yeah, I think without doubt that if we want to see better productivity, the only way that comes through is with improved automation. And so when you look at the expected benefits from improved productivity, they're really meaningful. And McKinsey
Mhm.
just recently did a study where they talked about U.S. being able to add $10 trillion to our economic output by 2030. Seems like a big number, and that's in the
10
context of
trillion, that's with a T, right?
right, 10 trillion. It
Yeah.
sounds like a big number, but if you sort of peel the onion, it really isn't. And but it is a meaningful number. Okay, so the
Mhm.
U.S. economy is roughly $25 trillion economy. So over the next 8 years, that's going to add roughly about again $10 trillion improvement with just a 2% improvement in productivity. Um, so that's what the numbers are. The U.S. or the world global economy is roughly 85 trillion. So that's over $500 trillion in size by 2030, and just improving that by 2%, gets you a pretty big number, right?
Mhm.
And so, if you look at what happened during COVID, the improvement was all 100% the result of productivity. And
Mhm.
we went into the pandemic and we exit the pandemic 1% higher GDP. We did it with 6.5 million less workers. That is the definition of productivity, all as a result of robotics, automation, and AI. And so I have high hopes and beliefs that this is exactly what's going to occur as we go forward. And I just continue to emphasize to our investors and to all investors is the importance of staying invested and staying the course in robotics, automation, and healthcare innovation. And the investors who have followed that guidance have already benefited from the recent reset that's already delivered plenty of green shoots. And I think that we're going to continue to see this. And not long ago, automation was considered a luxury for companies, looking to increase productivity and lower costs, improve margins, and sort of outplay the other tech savvy competitors
Hmm.
or less productive competitors. But today, as the cost of robots and other automation solutions is becoming increasingly affordable, automation shift from nice to have to a necessity. And with automation now a priority in nearly every sector, many of our companies are entering 2023 with record backlogs. So we got companies like Fanuc and Yaskawa and Rockwell and Daifuku, which does picking and sorting equipment, and another company, AutoStore, that's uh, a, um, a Oslo-based company that has robotic warehouse technology. Palo Alto Networks, um,
Hmm.
crowdsource, ASML that produces the semi-cap equipment, manufacturing equipment, Stryker. I mean, I can go on and on. All have record backlogs,
Hmm.
and I think this is important because the market is fixated on the macro, every day and wondering which way's up or down, and they're not really paying attention to what's going on. And our indices, I think, are kind of leading the charge forward.
Hmm.
So, what are some of the maybe some of the next areas where robotics is going to maybe become more mainstream? Are there any kind of immediate kind of fields where that's kind of the next thing? Like right now is like warehousing, manufacturing. It's had a big impact. Other
Yeah, I think
new
that's one
areas?
area that we're really excited about. I think, generally speaking, that the digitalization of the economy is obviously proceeding at a pretty brisk pace,
Yeah,
and business leaders all over the world are now taking full advantage of an increasing set of broad automation technologies out there, right? So everything from software to cloud to advancements in robotics and machine learning,
yeah,
and these trends are providing investment opportunities related to a few themes. And one of the themes that we love is warehouse and logistics automation. And
hmm,
generally speaking, autonomous systems are really beginning to take off, and the evolution of how humans move from sort of point A to point B is fascinating. Okay, it took centuries to go from traveling on foot and horseback um, to more efficient modes of transportation, right?
yep,
Horse and carriage, then to massive ships crossing the sea, and then you've got rapid succession came with the trains and the automobiles and airplanes, which obviously
yeah,
increased human mobility. Now we've got another big inflection point, and this is thanks to autonomous systems, which are enabled by connected electric and smart technologies. And smart robotics and AI and automation are revolutionizing the supply chain, and they're allowing for better integration and more efficiencies at all stages of fulfillment. In the US alone, there are roughly 20,000 warehouse and logistics facilities, and I believe roughly 5% would be considered heavily automated or
Hmm.
highly automated or even somewhat automated. So that
Hmm.
means that 95% of other areas are not, enabled.
wow,
And I think when you've got the speed and the flexibility and mobility of today's robots that prove the technology is more dexterous than ever, and you've got, a lot of other applications that are really evolving because of advancements in deep learning, and you've got radar, lidar, and vision technologies,
yeah,
sensors that can classify objects and sort them and use perception for better planning and route planning. I mean, we're seeing just a massive evolution here. Warehouse and logistics automation is roughly about 12% of our robo index, and it's actually one of our best performing subsectors since we launched almost 10 years ago. It's up in the neighborhood of 350%. And we're just scratching the surface on where things are going.
Hmm. So it seems like what you're saying here is, we're still in early days here. The widespread adoption hasn't happened, and even some of those names that you mentioned, as you mentioned earlier, the overlap with the S&P 500 and the Nasdaq. really isn't there. Some of those names are probably names that people haven't heard of before. So how do you kind of identify these potential winners? Do you kind of cast a wide net to kind of get all of them, and let the market decide who the winner is, or do you kind of drill down a little bit deeper and say, hey, this one is better because of, and what is that X factor, I guess?
Yeah, no, we don't cast a wide net. I mean,
Hmm.
we're not sort of trying to populate this with just throw paint against the wall and hope it sticks. I mean, we're really
Yeah.
trying to focus on identifying companies that have high revenue purity. Okay.
Hmm.
And to get into our index, that has to fit in one of our subsectors that we've defined. So that's the first thing. And then we're looking for the high revenue purity. And again, as we sort of initially talked about, we're trying to identify the companies that have dominant market share. I mean, we want to find the best of breed pure play companies. So we're looking for companies if they're not sort of number one, two, or three in share. Number three, not because they've moved down from one to three, and maybe migrating even lower. I mean, we're looking for companies that have staying power. We're looking at the companies that have commercialization, that have technology leadership. We spent a lot of time trying to understand their technology and the moats around that business. And then we're spending a lot of time understanding how and where they're investing. We look at their R&D and D and where they're investing. We look at their acquisition activity, their success, their historical track records, et cetera. So we spend a lot of time looking at that. We then cast a ESG filter around that,
Hmm.
and all pops an index, and then that is a very active approach to how we look at things. We balance it monthly. We trim the stocks that have rallied. We've bought into the stocks that have sold off, and we're constantly rebalancing. And we can own no more than well. After that's done, that's sort of the active approach. The passive approach would be we put it in an ETF wrapper, and then we have sort of passive filters. We look at a company has to be exchange trade eligible. It can trade no more than we can own no more than 5% of free float. It has to have a certain market cap and liquidity for us to be able to own it. And so
Hmm.
we review this, quarterly. Our portfolio, we're reviewing not just quarterly. We look at companies really on a daily basis. We have conversations and meetings with management teams. We meet them at conferences. We meet them in their offices. I mean, we meet with the competitors, et cetera. So we're constantly staying on top of them.
So
Hmm.
really really the key is find the leaders in these huge growth areas and concentrating on in on them to really kind of get the bang for the buck with there, right?
True, but we have what we call sort of a modified equal weight. Essentially, we have a more or less a 2 or 1% position in companies. So we're not really taking an overweighted, concentrated bet like some of our other competitors, have done. And we've done that very conscientiously because we know investors want to get from point A to point B with the least turbulent aerospace as
Yeah.
possible.
Yeah.
Uh,
Hmm.
Concentration, brings a lot of risk, and investors love it when it works, but when it doesn't work, they don't like
Yeah.
it. And we've designed this index not to pick the obvious winner. We think a lot of our companies, will be winners, and they are. They have been winners. Our returns speak for themselves. We're also fortunate that a lot of our companies are in the catbird seat to be acquired. I mean, because
Right.
Wow.
we
Wow.
don't just focus on big, massive, liquid names or big market cap only. We invest across market cap spectrum. It's roughly about 40% would be large cap. Or, I'm sorry, 40% is 45% US and the balance internationally. And we're probably again, more or less, I would say 30 to 40% large cap, and 60-ish%, small and mid cap. The median market cap for Robo is about 6 billion,
Mm.
and because we've capture a lot of exposure in small mid cap, we get a lot of impact from M&A benefit. Since we launched Robo We've had almost a third of our companies have been acquired or attempted to be acquired. That's a
Wow.
portfolio of around 75 names.
That's
Oh,
amazing.
wow. Yeah.
Yeah.
Mhm. Um, so, before we end this segment, I want to just kind of circle back a little bit because you mentioned, of course, Chat GPT is something that is kind of the new shiny thing, and uh, big adoption rate. A lot of people were very intrigued by it, wanted to try it out, wanted to kind of see what it's all about. Where does it kind of go from here? Is it still kind of too early to tell? Is this something that's investable right now, or do you just kind of have to wait for something this new to kind of get those use cases out there and get some of the wiggles out, I guess, in these early days?
Well, artificial intelligence is the big news right now, obviously, thanks to a wave of real applications such as, Chat GPT. And this tool and many others sort of demonstrate the quantum leap that's taken place over the last few years and what AI is capable of. And this way of innovation is, a process of hitting the world of business and redefine what's possible. I do not think that this is a fad. I think that the opportunity here, it's really in terms of igniting a deflationary tsunami, is very, very probable. As it has the ability to transcend pretty much every industry by optimizing growth and lowering costs. I mean, think about it. When was the last time that we saw a piece of technology that was so versatile that could solve problems and surprise people in so many ways? I mean, you've got
Yeah.
the ability to write a poem, a text, fill out a spreadsheet. You can write Python, code or do a structured, query language. So this is all the power that's coming to the consumer. I mean, think about what Google has enabled us to do in search. I mean, I think the average person probably does 7 or 8 searches a day. But imagine you do 7 or 8 searches 20, 30 years ago. I mean, you had to go to the
Mhm.
library and
Yeah,
look
it's
in
true.
books and do a search on something. Well,
Card catalog.
Yeah, it would take all day.
how, how much does the average whale weigh? I mean, we can ask Siri and they can tell you in less than 1 second. If you had to go to the library to do that, it might take you 30 minutes.
Right.
Mhm.
So I think we're scratching the surface of where this is going to go.
Mhm. Now, one thing I just want to address real quick, again, because this is still early days, and one of the issues that has come up with this technology is um, accuracy. So it's using the internet as its data source, and I think we all know that the internet is a great tool, but sometimes it's not necessarily giving you accurate information. So, any thoughts on how that kind of plays out?
Well, I think it will play out over time. I think that clearly explainability is difficult. You've got a lot of self-advised learning that has to happen.
Mhm.
You've got training costs that remain high. They continue to remain high. You've got inference costs, which are the costs of energy, and the computing costs are exceptionally high. It costs ChatGPT on average roughly 50 cents to $1 to do a query. Google do it for 1/100th of a penny. So these are all things that I think have people worried or apprehensive, if anything. But like every technology, you're going to see an exponential decline in costs going forward. And this is all a result of our computing capability, which has obviously exploded. I mean, virtually every 18 months, our computing power is doubling and the cost of computing is plummeting. So this is creating an array of use cases that years ago was just science fiction. And
Mhm.
ChatGPT is a further illustration of this. And I think the bounds are so wide here that it's got people just confused because they don't quite know what to make of it. But when the iPhone first launched 12 years ago, there was no such thing as apps.
Right.
And within 10 years, I think the app industry had grown to over $100 billion, revenues. I'm not even sure what it's now. It's probably, a magnitude of that. And so this all happens in a pretty fast period of time, and especially when you can get the ubiquity of these technologies disseminated like we can now. I think the anything can happen. I mean, again, ChatGPT got to 100 million users, inside of 2 months.
Mhm.
Yeah.
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 Yeah. Incredible
It's
stuff.
incredible.
Well, when we come back, we're going to talk about some of the themes that Bill is looking at right now for his ETFs and for the future of robotics, automation, and artificial intelligence. Stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen related subthemes. With clean hydrogen based energy expected to grow 5 times in the next 30 years, companies building hydrogen related businesses to generate power, heating, transportation, and more will likely thrive. Welcome back, everybody, to the Investing with IBD podcast. It's Justin Nielsen here, your host, along with Arusha Peiris, O'Neill Global Advisors Portfolio Manager, who joins me every week. And our special guest this week is ROBO Global President and CIO and Managing Partner. It's Bill Studebaker returning to the show. And just for people that want more information, of course, I should make sure that they know that they can go over to roboglobal.com for information. Also, you can follow them on Twitter at ROBO Global. Bill, let's get into it a little bit. Some of the themes that you're looking at, because again, you mentioned there's a lot of stocks, a lot of individual stocks, but kind of on the broader level themes, and we've had some of your folks on before in the past, and one of the interesting areas is certainly healthcare. So maybe you can start with healthcare and go into a little bit more of that. Certainly, we did just see a recent acquisition. To your point, One Medical is one of the stocks that we've had your folks talk to us about, and that got acquired by Amazon. But what other innovations are you seeing in that area?
Well, we want to talk about healthcare. So our HTech index, which is HTC,
Mhm,
um, enables investors to take advantage, really, what we think is a exceptionally long runway of growth in healthcare AI. And
mhm,
though healthcare is already a globally mature industry that's contributes somewhat of close to 10% of the world's GDP, we all know that expenditures are rising unsustainably and could exceed 18 trillion by 2040, according to our research. And so the need to simultaneously lower costs and improve, patient well-being has created really a breeding ground for innovation. And HTech really seeks to capture the value created by the technology companies enabling this necessary change. And as we're looking at healthcare, we're really excited because the rates of digitization in healthcare are some of the lowest of any sector in the global economy. And if you think about the world that we're in, we've sort of responded to the therapies or provided therapies after the problem has happened. But
mhm,
we're going to a world now of prediction, prevention, individualizing this, and so innovation, as example in cancer and disease treatment, continues to advance, and we all are beginning to understand that not all treatments are appropriate for every genetic makeup, and our health histories are very different. However, precision therapies facilitate very catered treatment plans dependent on the specific patient needs. So they're using companion diagnostics, liquid biopsy. Physicians can now sort of determine the most effective drug therapy on a patient by patient basis, and then monitor how each treatment protocol is performing, rather than just simply saying, this is how we're going to do it. Let's just wait and see.
mhm,
And for many cancer survivors, the risk of reoccurrence, as we unfortunately know, is high, and making it vital to monitor the presence of cancer in the body following treatment. And so liquid biopsy supports this effort through a process known as immunotherapy response monitoring, or minimal residual disease. MRD is what it's called. And one of the many benefits of this technology is reducing the unnecessary treatments, such as chemotherapy, when the minimum residual disease (MRD) is no longer detected. And
mhm,
so this is just an example of a situation. We have a company in our index, Natera, ticker NTRA, that specializes in this area, and they have this Signatera patient immunotherapy monitoring device that checks for the presence of MRD in cancer patients to determine if they're remaining cancer free through immunotherapy. And they just received Medicare coverage approval, and the stock responded quite favorably as a result of that. I think the stock was up, close to 20% or maybe even more as a result of that just recently happened. And so we're really excited about, precision medicine. I also think the world of connected care is about to take off. The medical IoT industry is poised for, I think, meaningful growth,
Hmm.
particularly as AI technologies, are seeing more adoption, and I think the expected velocity being driven by advancements in machine learning and cloud, and perhaps more importantly, the need for portable and non-invasive healthcare is paramount. And
Hmm.
that's, the Internet of Things is connecting now the physical world to digital world. And so when this connection occurs, this has a monumental impact in the medical world. And one example is, remote patient monitoring. So you're using, smart wearable devices to provide,
Right.
continuous stream of health metrics, right? You're gonna check the heart rate, and the blood pressure, and the temperature, and the glucose, and more.
So something
And
like the
so
Dexcom or something like that, right?
uh,
That
we think that the medical IoT market's going to double from 150 billion last year to over 330 billion by 2027. I mean, that's a CAGR of some close to 17%. So,
Hmm.
wearable glucose measurement devices. You have companies like Dexcom. You've got, Abbott. Allow for real powerful diabetes management. You've also got another company, PODD. Then you've got cardiac monitoring solutions. Abbott does that. You've got iRhythm, IRTCs. You've got Boston Scientific. So there's a lot that's happening there, and healthcare is an industry that's just ripe for innovation.
Hmm. So, what is it that's the most important here that you think in healthcare? And I know that's a tough thing because you just mentioned all of these different technologies, and it seems like they're all kind of benefiting from different things, from that precision medicine. But I guess if you could tie it back to what is the part of robotics, automation, AI that's, I guess, having the biggest impact here on some of these names that you just mentioned?
Well, I think the biggest impact is helping out with diagnosis.
Diagnosis.
And then it's helping out with, providing individualized, patient care.
Hmm.
That, guess what, is also affordable.
Hmm.
The rates of healthcare costs are just unsustainable, and so we need to tackle that firsthand. And our index aims to capture, a world that's moving to prediction, prevention, and individualizing medicine. So, I don't know that you can invest in one particular stock or one particular, sector, because that could get also, it does get overheated and dangerous. Like we have, genetics, or just genomics that's
Hmm.
about 10% of our index. Well, we know that genomics had a pretty tough year last year. A lot of the companies were down 50 to 90%. And we had suspicion that some of the valuations were getting a little bit out of hand 12, 18 months ago. And we identified a few different sort of fundamental filters that we put in to sort of minimize the impact from that. We put a filter in where we could only own no more than, well, a position size would be cut in half if the stock traded over 20 times EV to sales, and if it
Hmm.
had a debt to EBITDA in excess of 5 times. And so, you had a lot of companies in genomics that were trading at 30, 40, 50 times sales. Now, our index in aggregate, though, importantly, because we're diversified across all subsectors, um, our median EV to sales multiple is around 4.5 times. So,
Hmm.
this is not nosebleed. And again, we're,
Right.
we're, we're invested in precision medicine, we're invested in regenerative medicine, we're invested in genomics, we're invested into medical instruments, and a few other sectors. So again, I think it's important to be invested across many different industries.
No,
Yeah.
especially it seems like in the medical industry, the healthcare industry for sure. I mean, the adoption rates I feel like the adoption will be higher in certain areas than others. Will take a little bit more time, maybe getting the doctors to get used to adopting some of these things, and in addition to the patients.
It's true, but I guess yeah, it's interesting to see how it works. I mean, if you look back to Intuitive Surgical, they launched, I believe it was somewhere around 2000, well, sorry, 1998-ish or so. I remember, reading, analyst reports in the 98 to maybe 2004 period of time, and everyone talked about, doctor acceptance and penetration rates and procedure growth, et cetera. And everyone sort of questioned the technology, et cetera. But you know, now fast forward and into the surgical market cap, I'm not quite sure what it is right now. It's probably somewhere in the,
80
I have
billion.
to look it up, but maybe in the $60 billion zip code. It may be closer to, yeah, it's probably in the $6 billion area. And so, and you're looking at a company now that has close to a couple million sort of procedures that it's done, and procedure growth is in the neighborhood of 15+%. When you can operate with sub-millimeter accuracy, that results in better patient outcomes and lower costs. And really, it's all about these systems working alongside of doctors to help them do their jobs better. I mean, if you're a doctor at age 70, you may be, very skillful at
Right.
understanding the human body and anatomy, and you've done thousands of procedures, but guess what? You may have a little bit of tremor in your hand
Mhm.
and don't have the dexterity that maybe you had. So if you have a robotic assistant that working alongside of you to provide an accurate, minimally invasive um, surgery alongside with you, it's very active.
Yeah. You mentioned how the Internet of Things (IoT) is something that was also influencing the healthcare area, but of course, IoT goes well beyond healthcare. Can you talk a little bit more about that and some of the companies that interest you in that space?
Yeah, I mean, I think that what's happening now is that smart robots and AI and automation are really revolutionizing the supply chain, right? It's allowing for integration, efficiencies in all stages of the fulfillment process. So, if you look at where IoT is, I mean, you've got if you order something from Amazon, the chances are that guess what, one of Zebra's technologies have probably traced and tracked where your product is. So they have mobile computing devices that scan the various lines or assets to tell you what's been shipped and when it's been shipped. It knows exactly what color it was and where it was and what time it was sent and when it's going to be the next place, and then you can transition that into your CRM and understand exactly the inventory you have. So when it just along the supply chain, there are just a lot of avenues where this can be adopted. And when you think about adding smart automation everywhere, it's just vital. I mean, when you're adding basic intelligence and vision to anything, it's going to be a lot more productive. I mean, just imagine a deer that's running out in the middle of the Serengeti that can't see. Um, Probably isn't going to last a long time. But if you have, vision, you have eyes, you have hearing, you have sense, you're going to be much more adaptable and have much more intelligence. The same thing is in essence what we're doing here across, really a multitude of industries. Is just giving us a better lens into our assets.
Mhm. Yeah. And you kind of talked about some of the use cases here, kind of coming full circle back into some of this logistical warehouse stuff. I mean, certainly the Internet of Things that you just mentioned, a lot having to do with logistics, inventory control, but also, as you mentioned, the vision component here. Very important for warehouses as well. Anything else that can kind of uh, cap off this discussion on the themes that you kind of are looking at right now?
Well, again, I only see the biggest themes that if you just look at penetration rates of automation, of AI, of healthcare
Mhm,
digitization. I mean, we're talking about virtually every industry is in its infancy. We're in the very, very early innings of the game where penetration rates are in most cases in the low single digits. So,
mhm,
for people who think they might have missed this, hardly. I mean, we're just scratching the surface where this could go. I mean, we launched Robo 10 years ago. We had high hopes, anticipation that robotics would become, or automation would become, increasingly more ubiquitous. But fast forward 10 years later, we couldn't be more convicted in what we're seeing because now, again, it's become not just a luxury, but a necessity. And I think that business leaders across the world understand the importance. I mean, we have a full blown robotics and AI arms race going all
mhm,
over the world, not just with companies, but with countries. And so I think the rates of innovation are set to not decelerate, but only continually accelerate.
mhm. And
Yeah,
to your point, this has been, a pretty slow process. So for all of those that were worried that their jobs were going to disappear overnight, you were talking about how, hey, this is, I mean, it's amazing how far it's come, but as you said, it's been slow and will probably continue to be a slow process.
Yeah, I wouldn't say the word slow. I would say
Okay,
it's probably a little more. I would say
incremental.
it's a little more measured than people
Yes.
might think.
Yeah.
That's a little more reflective of the industrial side, where we talk about there's going to be 3.4 million industrial robots installed by the end of 2023. That's the cumulative number of robots globally. And that really pales in comparison to 500 million people that are employed in global manufacturing. And so this is a measured sort of level of growth in terms of what we see. The International Federation of Robots puts out their statistics every year, and we sort of see penetration growth of around 10 to 15% per year. So somewhat measured, and that's reflective of the supply chain. Some of the supply chain, can't get spec'd in quick enough. The technology's in there, got the capacity, and so it is a measure. We know what's going on with semiconductors, and it's a limitation for a lot of production capacity increases. So again, it's just a little bit more measured than we think, and I think that the important thing for a lot of investors and consumers and employers and everyone to think about is the robots aren't here necessarily to steal our jobs. They're really here to work alongside of us. And there's much more collaboration that's going on with automation than most people understand. I think that's a really important point to think about because I don't think we should be wanting to fear the robots. We should want more automation. That's the reality. I mean, we just don't like doing the dull, dangerous, and dirty jobs. And the nature of work has evolved for hundreds of years, and it's going to continue to evolve. And where exactly it goes, I can't predict. Obviously, there is a risk that we do have to have some regulations, around the growth as it relates to AI. And, we'll get there. Will that be a perfect ride? Will there be some mistakes along the road? I would imagine, but far better off than we were years ago. I mean, back in 1900, I think human longevity was probably in the neighborhood of 40 to 45 years. Now we're
Mhm.
probably in the neighborhood of 70, 75 years. Is that a good thing or a bad thing? I think
Right.
it's a good thing. I think kids that are born now are probably not going to live until they're 70 or 80, try 100, try 120 plus, as we've got the ability not just to arrest the signs of aging, but in many cases, reverse it. So there's a lot of benefits that are coming as a result of all these technologies.
Yeah. Well, we really appreciate you sharing your thoughts today on that with the impacts, as you said, not just longevity of life, but again, getting us out of some of those dirty jobs that none of us really want to do, and dangerous jobs at that. So, thanks again for your time. And as a reminder for our folks, you can follow follow them at ROBO Global on Twitter, and roboglobal.com is the website. So thanks again, Bill, for coming on the show again.
Thank you very much.
That's going to do it for us this week. Thanks so much for watching, and join us next week when we have John Kosar from Asbury Research returning. He's going to share with us his SEAF model, his Asbury 6, what he's seeing in the market, and where he's seeing some of the flows to the different sectors. So please join us for that, and thanks so much for watching us this week. We'll see you next time. Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.